Financial freedom is a goal many of us aspire to, but achieving it requires a clear strategy and disciplined execution. At its core, financial freedom means having enough money flowing in regularly that you don't have to work constantly to maintain your lifestyle. The key to reaching this level of independence is acquiring assets that generate consistent income and offer protection against market downturns and inflation. But what assets can help us achieve this? In today's video, we'll explore 5 essential assets that can help you quit your job and move closer to financial freedom. Before we dive in, make sure to like this video and subscribe to our channel for more insightful content that can help you on your journey to financial independence. Now, let's get started. 1. Dividend stocks. Dividend stocks are a powerful tool for building a stream of passive income. When you own shares in well-established companies, you're entitled to a portion of their profits, which are paid out in the form of dividends. This means you can earn money simply by holding onto these stocks without having to sell them. Different companies offer different dividend yields, which is the percentage of the stock price paid out in dividends. For instance, while Apple has a dividend yield of less than 1%, ExxonMobil offers a yield of over 3%. To put it in perspective, if you own a stock with a 3% dividend yield and the stock is worth $100, you would earn $3 per year for every share you own. However, dividend yield is just one factor to consider. It's crucial to invest in companies that are financially stable and likely to continue performing well in the future. Dividends are a reliable source of passive income, but they typically form part of a long-term investment strategy. To generate a substantial monthly income from dividends, you would need a significant amount of capital. For example, with an average dividend yield of 3%, you would need a $400,000 portfolio to generate $1,000 per month in dividends. This might seem daunting, but many investors use the power of compound interest by reinvesting their dividends to grow their investments over time. Although this approach requires patience, it's a highly effective way to build a steady stream of income. Plus, dividends are often taxed at a lower rate than regular income, making them even more attractive. 2. Cash-flowing real estate. Real estate is often touted as one of the best ways to build wealth, and for good reason. Property values tend to appreciate over time, and real estate can generate a steady cash flow if managed correctly. Take the U.S. housing market, for example. In the early 1990s, the average home price was around $97,000. Today, that figure has soared to over $400,000. One of the most compelling aspects of real estate is that you can own valuable assets without having to pay for them in full upfront. Let's say you buy a $200,000 house with a $40,000 down payment and finance the remaining $160,000 with a 2.5% interest rate over 30 years. Your monthly expenses, including mortgage payments, interest, insurance, and taxes, might total $830. If you rent the property out for $1,200 a month, you'd have a positive cash flow of $370 each month, or $4,440 annually. But the benefits don't stop there. As the tenant pays off your mortgage, you build equity in the property, and the property's value is likely to increase over time. Additionally, you can use strategies like refinancing to tap into the property's increased value. For example, if your $200,000 property appreciates to $250,000, you could refinance, take out $50,000 in cash, and use it as a down payment on another property. This way, your initial $40,000 investment could help you control $450,000 worth of real estate, doubling your cash flow in the process. 3. Bonds. Bonds may not have the appeal of high returns like stocks or real estate, but they play a critical role in a balanced investment portfolio. Bonds can act as a protective layer against market volatility, especially as you near retirement. Warren Buffett, one of the world's most successful investors, has often recommended a simple yet effective investment strategy. Allocate 90% of your money to index funds like the S&P 500 and the remaining 10% to bonds. Finance professor Javier Estrada tested this strategy using historical market data, and to the surprise of many, it outperformed more complex retirement strategies. Estrada even added a twist to maximize the protective benefits of bonds. He suggests that during market downturns, instead of selling stocks at a loss, you withdraw funds from the bond portion of your portfolio. Bonds tend to increase in value when the stock market is down, allowing your stocks time to recover without locking in losses. This approach not only safeguards your portfolio during tough times, but also ensures that you're maximizing returns when the market is thriving. Bonds might not be the most glamorous investment, but they are an essential part of a well-rounded strategy, particularly for those relying on their investments for income during retirement. 4. Cash-flowing businesses. Owning a business can be one of the most rewarding ways to generate cash flow. This doesn't necessarily mean you have to run the business yourself. Many successful business owners hire managers or partners to operate their businesses, allowing them to reap the rewards without getting involved in day-to-day operations. This could be anything from owning a franchise or a chain of ATMs to running an online business or application. However, owning a business does come with a higher level of difficulty compared to other forms of investing. It might involve starting a business from scratch and putting in the work until it's self-sustaining, or it could mean investing in an existing business that needs capital or expertise to grow. Despite the challenges, the potential rewards can be significant. As a business owner, you have control over how much profit you take home and can benefit from various tax advantages. For example, you can use pre-tax money for business expenses, like buying a vehicle for business use. Always consult with a tax professional to understand the specific benefits and regulations applicable to your situation. Owning a business can provide substantial cash flow and, if managed properly, can be a cornerstone of your financial independence strategy. If you're finding this video helpful, don't forget to hit that like button, share it with your friends, and subscribe to our channel for more content like this. Your support helps us continue creating valuable content for you. 5. Startups and growth companies. Imagine having invested in Amazon, Uber, or Netflix in their early days. The returns on such investments would have been astronomical. While we can't go back in time, there are always new startups and growth companies with the potential to become the next big thing. Investing in these companies can be highly lucrative, but it comes with significant risk. Many startups fail, and it's possible that your investment could be lost entirely. Because of this risk, investors typically allocate only a small portion of their portfolio to these types of investments. However, if you invest in the right company, the rewards can be life-changing. For instance, early investors in companies like Tesla or Airbnb saw their wealth multiply many times over as these companies grew into global powerhouses. That said, the best investment you can make is in your own education. Whether you're investing in real estate, stocks, or startups, having a solid foundation of financial knowledge is crucial. Without it, even the best investment opportunities could turn into costly mistakes. By investing in your education, you're setting yourself up for long-term success and ensuring that you can make informed decisions that align with your financial goals. Thank you for watching. If you enjoyed this video, please give it a thumbs up and let us know your thoughts in the comments below. Don't forget to hit that subscribe button and turn on notifications so you don't miss any of our future videos. See you next time.